Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 that is currently attempting to move back above its 100-week moving average. Now this is a moving average that has worked for decades as a definer of bull and bear markets. And you can see just very clearly here that it typically acts as a massive long-term level of support right here. And once it's broken in a clean manner, momentum tends to shift to the downside in a big way. We saw that throughout 2000. We saw that throughout 2008 right here. Momentum shifted in a big way here. And ever since 2009, we've been in what we call a secular bull run, where this moving average here has acted as support every time. Now often it dips just under and then snaps back above, and that can be a massive bullish signal for the next leg up in the market. So here we really are at a pivotal moment for the market, where on one hand you can see this as a retest of this moving average. If the SP 500 fails to stay above that moving average and starts to turn back down, that really does look like what happened in 2008 right here. Right? It attempted to move back above, it got rejected, and that's when you had very, very quickly, in under a year, you had a 50% drop from that failure. And then on the flip side of that argument, every time the price manages to pop back above the moving average, it sets off the next leg of the bull run. And you can check out this chart from our Twitter feed here that shows this phenomenon, where every time you have a pop back above the 100-week moving average, you get around a 30% rise in the market. Right? It's not always 30%, but it tends to at least be 30% before you run into another big top in the market. In 2020, we had a 70% move up. In 2017, it was a 40% move up. I believe it was also 40% after the 2011 test, and then of course much more in the 90s. But if you aim for around a 30% rise, that's already capturing a big part of the essential move. So now the question is, how do we figure out which scenario is going to happen? Are we heading into a bear market or a bull market? Are we heading for a 50% drop or a 30% run? And I can show you a couple more examples of where the 100-week moving average was a pretty accurate indicator of what was going on here. October 1973 here, you have after a big correction in the market here, around a 18% drop, you have the market surge higher in just a few weeks here, making a 13% rally, attempting to move back above its 100-week moving average. And then look at what happens, big failure here. Again in 1969 here, initial correction here of around 20%, just shy of a bear market. Then you have the market shoot back up to the 100-week moving average, 13% run, and then rejection, and the bear market resumes. Now before we dive into that, I'm just going to quickly ask you to smash that like button as hard as you possibly can, because it makes all the effort, all the time that we put into making these videos, it makes it all worthwhile, because it helps the YouTube algorithm to push our videos out to a wider audience, and following us every step of the way and seeing where opportunities arise. So to answer that big question, I really want to dumb it down to just one simple question. Are we heading into a bear market? Are we heading into a 50% drop right now? From the research that we've done so far, there's really two main reasons why the SP 500 could go into a bear market in the next few months, right? Two big reasons. And so if we find out whether those are very likely to occur, then we know if we should be protecting ourselves from that type of environment. Now the first reason, we'll call that inflation. And that's not similar to what we saw in 2000 and 2008. That is actually a lot more similar to these bear markets, 1970 and 1973. Now let's take the 1973 example right here. So you can see in 1973, you had the retest of the bull market moving average, as inflation was at around 8% here. You can see around 8%. Now you can see what happened following that. You had inflation continue to surge all the way up to around 12%. Inflation is what brought the market down throughout this entire period. It's because inflation was continuing to rise that you had this rejection. In fact, if we put oil's price here on this chart and take a look at what oil was doing right here as the market was attempting to recover back above the 100-week moving average here in October of 1973. If you take a look at oil, you can see the price went from around $4 here, $4, all the way to $10 in just a couple of months. So you had energy prices, which made up a significant portion of consumer spending back in 1973. You had energy prices more than double in just a couple of months when the market was retesting that bull market moving average. And so obviously that corresponded to a big inflation surge in the months following, as that surge in oil was reflected in the prices of all things. Now, if we take a look at oil today, we're currently at around $90. So investors who are expecting an inflationary bear market right now, similar to 1973, with a drawdown of around 45% from that level, you would need oil to go up to around $180, which would look something like this on that blue chart. Now, there are some people who think that's going to happen. So you do have to make your own research regarding this and whether or not you think that's going to happen. Now, from our research at gameoftrades.net, we don't think that's a likely scenario. A counter trend move on oil is possible, even when you take a look at the global supply chain pressures that were a big driver of inflation throughout 2021. And you can see this is the global supply chain pressure index that surged throughout 2021. Well, you can see it's coming back down here. So these supply chain issues that we had post-COVID, where you had this disequilibrium between the pent-up demand from all the stimulus and the reopening of the economy in the post-COVID world, because of COVID, that created that inflationary shock. And that does seem to be behind us right now, which does favor that inflation should theoretically begin surprising to the downside, which we actually got for the first time in quite a while this week with the 8.5% CPI reading. So inflation could actually be a tailwind in that scenario. Now, of course, if oil does make a big counter trend rally following this 30% move down, that's going to be bad for stocks. So that's something that investors should be aware of. If oil breaks out here and makes a counter trend move, you could see a little bit of short-term turbulence on the market. And so instead of seeing a V-shaped recovery like 2018 and 2020, well, it would look a lot more like perhaps 2011, where you had a retest, another retest of the low before the market did move higher. And same thing again in 2015. You had a brief dip under, then a failure, retest of the low before eventually the market resumed higher, right? That's the scenario where oil moves higher in the next few weeks. We're not day traders. We're not week-to-week traders. We focus on those longer-term moves. If we think there's a 30% upside from around these levels, we shouldn't care about this type of short-term volatility. Even though that can look very painful when it's happening, that would look very bad, and it would scare a lot of people. Now, going back to the second scenario, the first one is inflation, and the second one is an economic collapse. Similar to 2000, similar to 2008, the economy collapsed, company earnings collapsed, consumer spending collapsed, and so guess what happened to the stock market? It collapsed. And right, we can clearly see that on this chart here, that 2000 and 2008, the ultimate cause of those collapses in the market were earnings, right? So that's another thing that can cause a bear market right now. It would be a collapse in earnings, and a lot of people are talking about that right now. If you start to see the economy surprise to the downside in a big way and start to see defaults rising, delinquency rising, loan delinquency rising, big corporations going bankrupt, guess what's going to happen to the stock market? It's going to collapse. You're going to see a big move down. Now, we also don't believe that's going to happen because from what we've seen, from the data that we've looked at, and this is just our opinion on what's going on in the market, there's no crystal ball. We're all doing our best to figure out what's going on in the market and staying on the right side of the trade and really trying to take a look at things as objectively as possible. We took a look at the amount of savings that we had throughout COVID, so 2020 and 2021, which is absolutely massive. Huge amount of savings throughout COVID because of all the stimulus and the fact that people were at home not spending very much. And we compared that to the spending 2022 and 2023 estimated. And that tells us that the consumer is actually a lot healthier than just before the great financial crisis, where you had the savings between 2003 to 2007 that was a lot lower than the spending of 2008 to 2012. So the consumer essentially didn't have much money to spend. The consumer here was in a very weak shape before the global financial crisis, which doesn't seem to be the case today. Now, could the aggressive federal fund rate tightening eventually be reflected and eventually kill the economy? Absolutely, right? That's absolutely possible. That the global economy, especially internationally, is not able to withstand this type of very, very rapid and aggressive monetary tightening, especially when you have the bond market going absolutely crazy because of inflation and the dollar going absolutely crazy. These are very, very tough financial conditions that could be reflected a year from now and create a general, very tough global slowdown. But that is perhaps a question for another day. So I think you understand what our opinion is on the market. What is your opinion? Make sure to leave a comment down below to let us know. That's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button. Now, in the meantime, I wish you good luck on your trading and see you next time.